Are you eligible for a loan in India? Today we unravel the mystery behind loan eligibility. Understanding the ins and outs of loan eligibility is crucial because it sets the stage for your financial journey. Bear in mind that the eligibility criteria are not a one-size-fits-all. They vary from bank to bank and across different types of loans, making it a complex labyrinth to navigate. But don't worry, we're here to help you understand it all. So, let's dive into the world of loans and understand the nuances of eligibility. In India, we have numerous types of loans, each catering to a specific financial need. Let's start with home loans. These are designed to help you purchase a property or build a house. Then we have personal loans, which are unsecured loans that can be used for any purpose, such as paying medical bills or funding a vacation. Moving on, car loans are provided for the sole purpose of buying a vehicle. Education loans, on the other hand, are designed to fund higher education expenses, both domestically and internationally. We also have business loans, specifically crafted to meet the financial needs of entrepreneurs and business owners. There are also gold loans, where gold jewelry is used as collateral. And lastly, there are loan against property options, where one can borrow money against the mortgage of their property. Now that we know about the different types of loans, let's move on to the eligibility criteria. Loan eligibility in India is determined by a number of factors. First and foremost, your age plays a significant role. Lenders usually prefer applicants who are at least 21 years old and not older than 65 at the time of loan maturity. This is primarily because lenders are looking for borrowers with a steady income stream and the ability to repay the loan over time. Speaking of income, your employment status is another crucial factor. Whether you're salaried, self-employed, or a business owner, you need to showcase a stable income. For salaried individuals, lenders typically require a minimum of 2 years in the same job. If you're self-employed or run a business, banks usually ask for proof of business existence for at least 3 years. Next up, we have the credit score. This 3-digit number is a summary of your credit history, and it gives lenders a glimpse into how you've handled credit in the past. A score of 750 or more is considered good, but don't worry if your score is lower. There are ways to improve it, and we'll discuss those in a later scene. Repayment capacity is another key consideration for lenders. They assess this by looking at your fixed obligations to income ratio, or FOIR. This ratio is the percentage of your income that goes towards servicing your existing debts. Typically, if your FOIR is 50% or less, you're seen as having a good repayment capacity. Lastly, lenders also consider your existing liabilities. If you have other loans or credit card debts, these will be taken into account when determining your eligibility for a new loan. The fewer your existing liabilities, the better your chances of being approved for a loan. There you have it. Age, employment status, credit score, repayment capacity, and existing liabilities are all key factors in determining your eligibility for a loan in India. Now that you understand the eligibility criteria, let's compare different banks and their interest rates. Interest rates play a vital role in deciding where to take a loan from. They are essentially the cost of borrowing money, and naturally, we all want to find the best deal possible. So let's take a closer look at the interest rates offered by some of the most well-known banks in India. Starting with the State Bank of India, the country's largest bank, interest rates for personal loans can range from 10 to 15%. This variability depends on the type of loan and your credit score. If you're looking for a home loan, the interest rates can be slightly lower, hovering around 7 to 8%. Moving on to HDFC Bank, another prominent player in the Indian banking sector. Their personal loan interest rates are quite competitive, starting from 10.75% and going up to 21.3%. Home loans from HDFC can have interest rates as low as 6.7%. ICICI Bank, yet another banking giant, offers personal loans with interest rates ranging from 11 to 22%. For home loans, the interest rates can be as low as 6.70%. Punjab National Bank, also known as PNB, offers personal loans with interest rates starting from 12%, while their home loan interest rates start from 7.1%. Now, you might be wondering why these rates vary so much. Well, several factors come into play. The type of loan is one factor. Generally, secured loans like home loans have lower interest rates because the bank has some security in the form of your property. Unsecured loans like personal loans usually have higher interest rates since the bank is taking on more risk. Your credit score is another significant factor. A higher credit score indicates that you're a responsible borrower, which can help you secure a lower interest rate. On the other hand, a lower credit score might mean a higher interest rate or even loan rejection. Understanding interest rates can help you make an informed decision about which bank to choose for your loan. It's not just about the numbers though. Different banks have different policies, customer service standards, and loan processing times. So, you must consider all these factors before making your decision. Remember, a loan is a long-term commitment, and the right choice can make a significant difference in your financial journey. Improving your loan eligibility can increase your chances of getting a loan. Now, let's delve into how you can do just that. Firstly, focus on maintaining a high credit score. Your credit score is like a report card of your financial behavior. It reflects how responsibly you've handled credit in the past. If it's high, banks will see you as less risky. So pay your bills on time, don't max out your credit cards, and avoid applying for credit too often. Next, reduce your existing liabilities. If you're already juggling multiple loans, lenders might be hesitant to add another to the pile. So, before applying for a new loan, try to pay off some of your existing debt. Not only will this improve your debt-to-income ratio, but it will also free up more of your income for future loan repayments. Thirdly, prove you have a stable income. Banks want to know that you have a reliable source of income to repay the loan. If you're salaried, this could mean showing payslips or an employment letter. If you're self-employed, you might need to provide tax returns or business financial statements. The more stable your income, the more comfortable lenders will feel about giving you a loan. Additionally, consider having a co-applicant or a guarantor. If you're finding it hard to meet eligibility criteria on your own, having a co-applicant with a good credit score and stable income can boost your eligibility. However, remember that the co-applicant will also be responsible for the loan repayments. Lastly, maintain a healthy relationship with your bank. If you've been a loyal customer and have maintained good financial conduct, your bank might be more willing to extend a loan to you. So keep your accounts in good standing and don't hesitate to leverage your relationship when applying for a loan. By improving your loan eligibility, you can secure a loan at a competitive interest rate. With these tips in mind, you're well on your way to securing your desired loan. Remember, it's not just about being eligible for a loan, but also about securing it at the best possible terms. Obtaining a loan in India might seem complex, but with proper knowledge, it becomes a walk in the park. We've traversed a wealth of information today, from the vast landscape of loans available in India to the nitty-gritty of loan eligibility and the critical practice of interest rate comparison. To wrap it all up, let's take a moment to revisit and summarize these key points. First off, we learned about various types of loans that cater to diverse financial needs, from personal loans for urgent cash requirements to home loans for your dream house, education loans for higher studies, and car loans for that shiny new vehicle. The Indian banking sector has got you covered. Each loan type has its own set of eligibility criteria and interest rates, which brings us to our next point. Eligibility for a loan revolves around your financial stability and credit history, among other factors. Your income, employment status, age, credit score, and existing liabilities play a crucial role in determining your loan eligibility. The higher your credit score and income, the lower your interest rate usually is. So, Keeping your financial health in check is paramount. Comparing interest rates among different banks before settling for a loan can save you a significant amount of money in the long run. Banks like State Bank of India, HDFC, ICICI, and others offer competitive rates, and it's worth spending some time to find the best deal for your needs. Lastly, we touched on ways to improve your loan eligibility. Regularly checking and improving your credit score, maintaining a steady income, reducing existing debts, and choosing longer loan tenures can all contribute to enhancing your loan eligibility. We've only scratched the surface of this vast topic, but we hope this gives you a head start in navigating the complexities of loans in India. Remember, the key to a successful loan journey lies in understanding, comparing, and maintaining your financial health. With this, we hope to have made the concept of loans in India clearer to you. Until next time, stay financially savvy.